This is Tom Aspray with the Viper Report Market Wrap video for the week ending January 16th. Is it too late to turn bullish? That may seem to be a strange topic for someone who's been pretty much bullish since the October 22 lows. The basis for this thought today is your position in the market really depends on your perspective. This was triggered by a client who, after looking at our current position, wondered whether he should still jump in with both feet. We have some nice open profits here, but some of these have been here for a year or even a couple years. Traders, our position in the home builders is sort of, we don't expect it to go up 10% in a couple of weeks. That's, more likely would be, something like the position in healthcare services, which we've been into since September, up 10%. So why does the perspective matter? This is a chart we often look at, NYSE Composite, a broad measure of the market. One of the best things that's happened in the past month or so is that the New York Composite has started to outperform the S&P 500 and the Qs. You can see we've moved up here nicely, but we're pretty much close to the Stark band. And that's why if you're not invested at all right now, I'd only be nibbling on a few select items, because I think we will see a more significant pullback as we head into the first quarter. The risk is best, of course, when you're near the Stark bands, the lower Stark bands, and occasionally we see areas like this in early 25, we moved sideways and there were some warning signs from the technicals that reduced our position, and as we felt the risk was high. Nothing quite yet like that, but let's look at some of the charts. You can see the S&P 500 AD line made another new high last week, as did the NYSE All AD line. So that's great. If we get a correction, I would expect both AD lines to hold close to those moving averages. In December, we noted this trading range. You can see it in this red box, and the AD line here broke out of its range, and we were looking for a similar breakout in prices. That often happens with the AD line. You can see this line C here. We broke out in August and saw a pretty good 2.5 month run to the upside. Then we had another trading range as line B, that we started to break out of in late December. And, now the target from that range was at 22,900, and we're at 22,807. So that's a bit extended. Also, you can see from the bull minus bear ratio last week, the bullish percentage surged. Now the differential means there's 21% more bulls than bears. More like to be a buyer where it's minus 20. That means there's 20% more bears than bulls. And of course, back in May, there were like 40% more bears. That and the Stark bands give you a really good setup. If you just look at the last 6 months of data, you can see that we're also close to this daily Stark band, above the R2 already, even though it's halfway through the month, and we formed a doji on Friday. Also noted dojis in a few other market averages. That's one thing I tell my students to do, particularly if they have a position and they're deciding, do I take profits here, or should I hold on? If you see a doji forming with your position, time to take a second look. See the AD line here was very strong, almost too strong on a short-term basis. It turned down. It would not be unusual to have it come back to that moving average. The fact that the moving average is rising so sharply means that that should be another buying opportunity. You can see that was the case back in August and September. Very few warning signs. That's also a plus for the near term, but that could change in the next week or two. New highs close to making a new high last week. In fact, they did on Thursday. New lows, that's our barometer. We don't get worried about the new high-low analysis until the new lows break out. We haven't seen that in the NYSE composite or in the NASDAQ composite. In fact, we broke this downtrend here in the number of new highs. That's a good sign. Still we're looking from 500. If we should see a spike in the new lows above 500 on 2 consecutive days, that would definitely be something that would get my attention. Back in November, it was a much better buying opportunity. You can see we had this peak in October. The pullback lasted about 3 weeks here. Big downside day that was met with buying, and we're near the daily Stark band, and the AD line quickly reversed to the upside and then broke out above this resistance. Right now we're right at the R1 for the SPY, and we're above both the 20-day and the 50-day. Those are our support levels we're watching. It wouldn't bother me if we saw a pullback to the 50-day, but the R2 is 700, 703. That's also a fib target, so that's 20 points above where we are right now. That could happen in a day or two. And based on the AD lines, you can see they're still positive. Another new high in the S&P 500 AD line that broke out last week. All AD line has turned down, but cleared a major trading range. The QQQs, as you can see, made very little progress over the past 4 weeks. We're down 0.9% lower last week. Looking ahead, we do expect this market to come back to life eventually. 20-day EMA or 20-weekly EMA, or I'm sorry, at 603, about 18 points below where we closed. So that's a support level. AD line made a new high here, pulling back into this support level. So, if we were to break that support and then this low here, that'd be time for a change in tune. The RS has been moving back and forth above its moving average. Currently it's below it, so suggests the QQQs are not ready to lead, at least right now. That view is consistent with the Qs. You can see we tried to make it above this downtrend here, and the R1 in the Qs for January at 628.64, but have since turned lower. So if we get much below 614, we could get back into the S1 for the month, which is 599. That should really get the market's attention. If it's confirmed by a break in the NASDAQ 100 AD line below the support line B, that would suggest, okay, well, maybe we're going to go a little bit lower than that. Daily RS still in a downtrend. You can see, we talked about that correction, that from the October highs, you can see that was forecasted by the RS, which started to top out here, and we have formed a doji there, and then 3 weekdays up, and we are trading at the R2 for October, so we had a bunch of warning signs. Both the VIX and the VXN are trying to stabilize here. You can see closed above their moving averages. So if we get above last week's highs, that would be a sign that volatility is increasing, typically a negative for the stocks. So you can see major resistance here around 18 and just about 22 on the VXN. Crude had a nice bounce last week, up 3%, I think, 3.25%. Still looking at it in this perspective, spreading it against the S&P 500, it's still acting weaker. So, bunch of the stocks had really good moves. So, typically, if this is a fake rally, they should fall back down to near the week's lows. Otherwise, if we consolidate, might be a more important transition is taking place. It was another good week for the small caps. You can see this is the IJR, the S&P small cap growth, or the core, I think, and added another 1.74%, breaking out above that prior high going back to late 24. So I think it could make it up to that 135 area. It's quite stretched on the upside in terms of how far above it is above its weekly start band. I think it's about 11% in the IWM. So that would mean I'm not adding in here certainly, and I'll be looking for any signs the rally is. And of course, this is one of the big questions. You can see this is the growth IWF versus the IWD, the value of Russell 1000. And I had a peak up here, so growth has been declining since then. It's been leading for this period of time. Is that a major top? Well, I mean, technically, certainly at this point, the momentum is still down, is still favoring value, but I need time and more evidence to suggest a major top. What I can tell you is the way the MACDs are declining and negative, does suggest it's not over yet. So if we can hold this support down in here, that would be a sign that maybe growth has not topped out. Clearly, we're out really of the tech part of the market right now, having scaled out in October, and we're okay with that. Looking at a watch list, there were new weekly positive signals in FXE. Okay, so that's a sell signal. That's positive for the dollar, negative for the euro. We'll see if that can manifest it in a better than a oversold bounce. Real estate showed up on a couple of different ones, as did crude oil. Consumer staples had a great week, and the Vanguard real estate also was strong, and as was the XLRE. Looking down at the growth value, 81.7 of the ETFs are bullish. Growth 70%. Okay, so you can see that it's lagging a little bit. Only 50% of the growth ETFs have a positive weekly, whereas 90.9% in the value have a positive weekly. So not surprising here. The short ETFs, only the Qs, the short Qs is positive, and here, but the rest of the short ETF leveraged are still on sell signals. Some weak buys here. The TQQQ is negative based on the DTS, but overall 100% of those are positive. A number of changes in the sector ETF report, which was sent out to subscribers yesterday. And you can see energy, the RS, powered to the upside here. I'm still a little bit skeptical. You can see we saw a similar move here, and it was quickly reversed. So, of course, the geotensions, would be hard to figure out what way that's going to end up in terms of oil. But clearly, there's a fair amount of oil out there, and we're not sure people really want the Venezuelan crude at this stage. But I will be keeping an eye on some of these energy stocks that haven't joined the party. PSX, COP, they have 1 hour, and also in MPC and in Oxy. So 90% is tough to argue with. Materials also has had a rocket ship. You can see this is much more sustainable, in my view, trend of the relative performance. Industrials also looking good, and 75%. That's what we like to see. Consumer discretionary is holding up. We reduced our position there, and you can see there is a bunch of red out there. Amazon, flashed a 1 hour buy the end of the week. We'll see if that's significant. Consumer staples had a great week, which was forecast by the grid analysis. My colleague Jerry A shared his rotation analysis on the staples. You can see this from last week, bullish rotation and bullish overall state, and watch for further bullishness. The RS, was not as strong as I'd like to see, but as Jerry pointed out, it did reach the support. And of course, you can see down below, we have this week's reading. The volume's a little lagging here, but there's a couple of things, that do look a little more interesting. Coca-Cola and P&G. So, that's typically a defensive sector. So that also could be an early warning of a market pullback. Healthcare still looks pretty good at 66. See lots of red in here, so lots of stocks to watch. You can see that, if they're all red here, we'll start to look for a progression. Above the 10 EMA, above the 1 hour DTS positive, 4 hour, and then look for the DTS. You can see MDT is leading in, has a positive 3 and a weekly. Rest are negative. Volume here, the pattern is not that great either, but overall the healthcare sector looks pretty good. Financials, we are looking for a buying opportunity there. It's pretty much gotten hit. Lots of red there, but we're looking, at the yearly pivots for a turn near that yearly pivot level. And technology, still all red. It's got some room, I think, quite a bit lower. If we do see a correction, we get on the mid 120s for the XLK. XLC, this grid is not looking very good. We're using a pretty tight stop there, and just simply because it looks like whether I'm not ruling this out. This has been the Teflon sector since 2023, so not convinced that we've seen a long-term trend change there, but we can like to sidestep the corrections if we can find them. Utilities back to strong once again, a more defensive place, 91.7, and as we said, there's some positive signs from the real estate, weekly buys in those, and you can see the downtrend here and the relative performance may have finally turned. We'll see more in Monday's report. So if you weren't fully invested for most of last year, I think there's money to be made. Just wouldn't be as heavy buyer right in here, as I mentioned. If you want to go on the Viper report, you can see what our current positions are. This is as of the 14th in both, the Viper ETF and the hot stocks. Some good stock positions. Some good. There's a few more buying opportunities in the stocks, frankly, than there are the ETFs, since they're pretty stretched. And if you want specific advice, Viper ETF or hot stocks, or if you're interested in mentoring, contact us at Tom@viperreport.com or at Wentworth Research. You had to use a different platform or use system to record today's video. Hope it turns out okay for you. Thank you very much.